Here we have a bit more of an extended balance sheet for the parent and subsidiary. A bit more detail in the assets. We have inventory, receivables from the subsidiary and receivables from third parties, a cash element, equity section is the same, and then the liabilities, we have payables to parent and payables to other. And what we're going to do here, we're looking at inter-entity transactions and also transactions that happen over the year end. So if there's cash in transit or goods in transit, they'll be appearing on the balance sheet of one entity but not the other. And when we consolidate, we need to just tidy those up. Also, of course, if there's goods being sold from one entity to another, they can just be cancelled out. We'll look at the profit aspect of that in a moment. But for now, it's just cash in transit or goods in transit and cancelling off transactions. So let's have a look. The question says cash in transit of 20,000 from the subsidiary to the parent. Well, it was in transit at the year end. So what does this mean? It was from the subsidiary, so it means these payables have been reduced and the cash has been reduced and it's not arrived at this end yet. Somewhere in transit. So it means we need to make an adjustment here to kind of accelerate the transit elements as if they had already happened by year end to make sure things all match up. So we need to add 20,000 here, so it's plus 20 to the cash, because that's going to the parent. And what we'll also do is we will remove 20 from the receivables from the sub, because they will have notionally paid that invoice. Minus 20. So here we've got plus 20 and minus 20. The balance sheet's still going to balance, but it's just that these numbers will have changed and will be more correct. So that's the first one done. We can have a quick look at the double entry for that. So we've got cash in transit, and this is for the parent. We'll do debit. So what are we going to debit? We'll be debiting cash to increase cash. Debit cash by 20,000, and we will be crediting receivables by the same amount. So that's the double entry for the cash in transit. Let's just tidy that up, and that's at the parent. So that's that one done. What's the next one? The inventory sold by the parent to the subsidiary for £10,000 was not received until after year end. So the inventory has, which way has it gone? It's gone out of the parent, so it's disappeared from here, and it's not appeared there yet. So let's just do this while we're talking. What we'll call this inventory in transit, and this is going to be at the subsidiary end. Need to make the adjustments. So we are going to debit inventory. Inventory is an asset. Debit to increase, so that's 10,000. And we're going to be crediting inventory sold. So if it's not in the warehouse, it won't be classified as under the ownership of the subsidiary. So the receivables, or rather the payables, won't have been recognized yet. So we're going to need to increase the payables So we'll increase the payables by the same amount, 10,000, 10,000. So we're increasing inventory here, so we can just do an adjustment here. So that's going to be plus 10,000. And to make sure it balances, we're going to do plus 10,000 here. Okay, so that is the adjustments. These are going to balance because they're both on the same side of the balance sheet. That's still going to be 420. This is going to drop down to, or increase to 130, as is this. And then we've done the two cash in transit and the inventory in transit items. Now there's one more exercise to do, of course, so let me just remove these, which is a shame. Perhaps I can just move them rather than remove. Almost. Not quite. Ignore that. I'm going to now do the consolidated balance sheet. Or rather, I'm going to do the adjusted two balance sheets. So what we'll have here is this will be 150. This will be 50. Let's just put these in, parent and sub. Parent and subsidiary. So this is the adjusted figures. 150, 50. So we've got 90 minus 20, plus 90 minus 20 is 70. This is just 80. This is plus 50 plus 20. And if all has gone well, this should still be 420, which it is. These have not changed at all, so we can just bring in the whole lot. In fact, we can bring in the whole of that. Tidy that up a bit. So this section is exactly the same. Payables to other side or to other entities is unchanged. So that still balances, and that's fine at 420. So we'll have a look at the subsidiary now. Inventory is plus 40 plus 10. No receivables from itself. Receivables are the 50. Cash 30. Gives a total of not 80 but 130. These are all unchanged. Excuse me. So that's 70. Here we have an adjustment, plus 40 plus 10. This was the inventory that moved from one place to the other. This was the payables to the other. So if we add this to this and this, with any luck, it should be 130. And it is. So that's always a good sign. But we're not finished yet. Not only have we done the adjustments, we now have to do, we can just kind of cancel off any items, any transactions between the two. There's no point, once we've consolidated, paying yourself or having payables due to yourself. So we've got payables to the parent here, and we've got receivables from the subsidiary. We can probably cancel those. So that's going to just leave, we'll cancel out the 50 maybe, to leave 0 here. And do another adjustment. We'll do minus 50 here, and here on the receivables we'll do minus 50 as well. And we won't add that into the two balance sheets because they won't balance, but when we consolidate we'll take into account these additional adjustments. So this was payables due to the parent and receivables due to the subsidiary. Of course, when we consolidate, they will just cancel each other out. So that will give a figure of 20 here and 0 here when we do the consolidation. And we'll do that in the next video.